$1,500. That's how much the average American spends per week. That's a round-trip flight to Europe or 3 PS5s. But what if you took just $5 of that, the equivalent of a Starbucks coffee or a dozen eggs, and invested it every week instead of spending it? How much money could you actually make? I wanted to find out. But here's the thing, in today's world, $5 is barely anything. Would it even be worth investing it? To answer that question, I tested the amount someone could make by putting $5 into different investments every week and letting it sit there for 10, 20, even 50 years. And let me tell you, the actual dollar amount just $5 a week can turn into is a lot bigger than you'd think. You'll see at the end. But first, how do you even invest the money? Well, you have a couple different options, including stocks, bonds, savings accounts, mutual funds, ETFs, and many more, each of which come with their own pros and cons. However, for this experiment, I'm just going to be focusing on savings accounts and index funds, which can be a mutual fund or an ETF, because they're both great for passive growth over long periods of time. But you may be wondering, how do each of these investments make your money grow? Well, for savings accounts, this happens through something called interest. Basically, the bank pays you a small amount of money for letting them hold onto your money in the account, meaning your account balance will get bigger over time. For index funds, it's a little more complicated. These take advantage of stocks, which are tiny slices of what is the big pizza of a company. This makes you the owner of a part of that company. These companies are similar to banks in the way that they pay you extra money for putting your money into their company in what is called a dividend. The performance of a company actively affects its stock. If the company is performing well, the stock will go up, meaning its value or price will go up. But the opposite could also happen, causing the stock's value to go down. You could use your money to buy the stock of just one company, but that means if that company loses money or has a bad year, your investment will drop too. It's like putting all of your eggs in one basket. This is where the concept of an index fund comes in. Instead of putting all of your money into just one company, index funds split your money into small amounts across hundreds of companies at once. This means that the bad performance of one company's stock can be balanced out by the good performance of another. Over time, you will gain more and more money due to the dividends from the companies you invested in through the index fund. Although they make your money grow differently, savings accounts and index funds have one thing in common: compound growth. You see, your money can grow through linear growth or compound growth. Linear growth means you earn the same fixed amount of money at the end of every period. For example, if you earned a flat $10 a year for 10 years, you would just have $100. Because it's constant, linear growth can be graphed as a straight line. On the other hand, compound growth means your money grows on top of itself. Instead of earning money only on what you originally invested, you earn money on your original amount plus whatever you have already earned before. Think of it like a snowball rolling down a hill. It starts off small, but as it rolls down, it gets much larger and faster over time. The same can be said for your money. As a result, compound growth can be graphed as a curved or exponential line. Compound growth is why the time you hold an investment for matters so much. Over a short period of time, linear growth might be identical or even better than compound growth. But as time goes on, compound growth quickly overtakes it and leaves it in the dust. That's why for this comparison, we will be using compound growth to analyze investment of a small amount over a long period. Now that we know how each of them work, I wanted to compare what investing $5 a week into each of them would do over different time periods, whether one of them was clearly better, and most importantly, if investing that money was actually worth it. You might be asking, why wouldn't it be worth it? You're literally getting free money. Well, although that's true, there is another problem we have to deal with: inflation. This is the slow increase of the prices of everything over time. Inflation is one of the reasons why that Lego set from 2018 is so much more expensive now, or why people are upset with prices in general. It means that your money is losing buying power. $10 today can buy a lot less than it could 10 years ago. So, in order for these investments to be worth it, they also have to beat inflation in order to make a profit. If your money loses its value because of inflation faster than the bank or companies can give it to you, you will actually lose money instead of growing it, and nobody wants that. Now, let's actually get to what $5 a week will look like after different periods of time, all the way up to 50 years, while seeing if there's a difference in what you invested. The graph on screen right now shows what investing $5 a week will look like after just 1 year. Time passes as you move further right on the graph, while the amount of money you have will increase as you go further up. The red line represents the dollar amount in the savings account, while the blue line represents the amount in the index fund. As you can see, they're practically neck and neck, but the index fund just slightly edges out the savings account. Here's a closer look where you can see that after 1 year, you will have around $267 if you invest in the savings account, compared to the around $273 you will get by investing in the index fund. So after 1 year, there's only a $6 $6 difference between the two, and the lines seem to be linear and not compound like we established. But overall, these numbers are barely more than the $5 a week that you put in yourself, which totals to $260. But wait, we forgot one more major thing: inflation. On the screen is a new graph with the red line being the amount in the savings account without considering inflation, while the purple line represents the amount in the savings account with inflation. As you can see, inflation led to a clear drop-off between the two. We can see that you will actually have $258 in the savings account with inflation, which is actually less than the $260 you put in yourself by investing $5 a week, meaning investing for a year actually lost you money instead of making you money. Taking a look at the index fund, it's only a little bit better. The blue line is the amount in the index fund without considering inflation, while the green line is the amount in there with inflation. The index fund will actually have around $265 with inflation after 1 year, which is only $5 more than the $260 you invested. So was investing so much for only $5 even worth it? Let's see if that'll change after investing $5 a week for 10 years. The red line again represents the amount in the savings account, except with inflation factored in, and the blue line is the amount in the index fund with inflation. You can see that the gap between the two different investments has definitely widened, with the index fund growing a bit faster than the savings account. The growth still looks fairly linear for the savings account, while we can see a bit of compounding for the index fund with the line curving. If we look closer, we see that after a decade of investing $5 a week, the savings account will now have around $2,442, while the index fund will have about $3,319. Taking into account the $2,600 you would have to put in yourself over the 10 years, we see that the savings account will still lose you about $158, while the index fund will make you around $719. So even after a whole decade, the savings account is losing to inflation, while the index fund makes you a bit of money, but not nearly enough to make investing for 10 years worth it. Maybe it'll change after 25 years? Here are the graphs of the two different investments. Wait, where's the blue line? Let's go up and up and up. Ah, there it is. Wow, that's a pretty big jump. If we zoom way out, we can barely fit it up there at the top. Clearly, the index fund has taken a huge jump, and we can now clearly see the compound growth with the graph curving even more. On the other hand, the savings account still looks linear and is way below the blue line. It seems pretty clear that the index fund is better than the savings account. But let's take a closer look. After a quarter century, investing $5 a week in a savings account will become $5,736, but in an index fund, it will be around $13,850. Subtracting the $6,500 you would have to put in yourself, the savings account will actually lose $764 due to inflation, while the index fund will make you $7,350. It looks like the savings account has failed to beat inflation yet again. But why is that? Well, there are a few different reasons, but the main reason is the interest rate. The savings account has a 4.5% annual interest rate, or APY, which means that at the end of every year, you will get 4.5% of the amount in the account added back. However, the index fund has a 10% interest rate, which is much greater than the 4.5% of the savings account. But you may be wondering why the savings account investment is still causing you to lose money even though it has a positive APY. Well, inflation has a value of around 3%, so subtracting that from the 4.5% will leave only 1.5%. Although that's still positive, we have to remember that a $5 bill in year 1 is worth much more than a $5 bill in year 25. So even though you're still investing $5 a week, the value of that $5 is decreasing as time goes on, no matter what it says in the bill. As a result, the savings account's growth rate barely holds against inflation, meaning it never actually gains real buying power, although it does profit. If we compare this with the index fund, after inflation, it has a 7% growth rate, which is large enough to outpace inflation. But now, the moment we've all been waiting for. What does investing $5 a week look like after 50 years? Well, it looks like this. We've zoomed way out to fit the blue line in, and we can now clearly see the compound growth and curved graph from the 7% growth rate of the index fund. Meanwhile, the savings account still looks linear, but we can see it start curving just a bit as we keep going. Now onto the numbers. After investing $5 a week into a savings account for half a century, you'll have $11,174, which again means you will actually lose $1,826 since you would have invested $13,000 yourself. But the index fund tells a whole nother story. You will have around $87,006 in the index fund, which means you will make $74,006 after 50 years. That's insane. That's almost 6 times as much as you put in. Now that's well worth it. So if the index fund has been better at every single time interval, is there no point in investing in a savings account? Well, not necessarily. Savings accounts are still great for short-term investment for 1 to 5 years because your money is guaranteed to be safe and will still give practically the same profit as an index fund. The thing about index funds is that they do come with some risk. Since they operate on the performance of stocks, which can rise and plummet, they still have risks of losing money, even though they invest in hundreds of stocks. So if you're planning on long-term investments like a decade or more, index funds are the way to go. But for short-term ones, savings accounts are your best friend. Of course, this model assumes you're able to deposit $5 every week and doesn't take taxes, account fees, stock market swings, or changing interest and inflation rates into account. But even with those, what people say about investing early is definitely true because you'll still be able to make a great profit. And who says no to free money?